Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. In today's video, I'm going to talk about the dividend payout ratio. This is one of the most important metrics to understand as an income investor because it can help you avoid dividend cuts and find stocks that are more likely to deliver steady dividend growth. We'll calculate payout ratios for basic corporations like Coca-Cola, as well as high-yielding REITs and master limited partnerships. But more importantly, I'll explain how you can use payout ratios to make better investment decisions for your portfolio. So, what is the dividend payout ratio? Most companies that pay a dividend do so because they generate more cash than they can invest in high-returning projects. Companies in this position have four options with how to spend their profits. They can pay down debt, make acquisitions, buy back shares, or pay a dividend. In the case of a simple lemonade stand, you don't see too many kids in our neighborhood pursuing debt-funded acquisitive growth. No, all profits are paid out as a dividend to the owner, the kid. But a growth-oriented company like Nvidia prefers to pay a very small dividend, retaining most of its income for future investments and share buybacks. A payout ratio makes these differences clear by calculating how much of a company's profit is paid out as a dividend to shareholders. Payout ratios are expressed as a percentage and simply divide a company's dividends by its earnings over a fixed time period, usually 1 year. Let's calculate Coca-Cola's payout ratio in 2023. On Simply Safe Dividends website, I can pull up Coke and see that in 2023, the company made 4 quarterly dividend payments of 46 cents each. That adds up to $1.84 per share of dividends for the full year. As I scroll down here, I can find that Coca-Cola's earnings per share for 2023 were $2.69. When you divide Coke's $1.84 of dividends by its $2.69 of earnings, you get a payout ratio of 68%. This tells you that for every dollar of earnings, Coke paid out 68 cents of dividends and retained the remaining 32 cents for other uses like share repurchases, debt reduction, and M&A. There's more than one way to calculate a payout ratio, though. In Coke's case, we looked only at the company's earnings, but some investors like to analyze a company's free cash flow payout ratio. Unlike earnings, which include non-cash items such as depreciation, free cash flow measures the actual cash generated by a business after it has invested to maintain or expand its asset base. While this might make free cash flow sound like the superior metric when it comes to measuring payout ratios, that's not always true. Free cash flow can be noisy any given year if a company invests in a major growth project that will take years to start generating revenue, or if certain working capital accounts like inventory experience major fluctuations. You can see that Coke's free cash flow fell in 2016 through 2018, pushing its payout ratio above 100%. This was driven in part by the elevated capital spending required to exit most of its company-owned bottlers and focus instead on selling capital-light concentrates and syrups. During this time, Coke's adjusted earnings per share, which exclude one-time items, remained steady and portrayed a more realistic picture of the company's earnings and dividend coverage. Over the long run, earnings and free cash flow should be similar to each other for most mature businesses. I personally prefer to look at the earnings payout ratio since it does a better job at tuning out noise than the free cash flow payout ratio does any given year, but they are both helpful to glance at and investigate when anomalies arise. A few types of stocks that pay high dividends don't use earnings or free cash flow to calculate their payout ratios. Starting with REITs, accounting principles require them to record depreciation charges for their properties each year, just like every other type of business. But since real estate accounts for most of a REIT's assets, these non-cash charges significantly reduce their reported net income, even though properly maintained real estate generally rises in value over time. If you look at sites like Yahoo Finance that use as-reported net income to calculate all their payout ratios, you'll often find REIT payout ratios that are well over 100%, like the 242% shown here for realty income. Using a cash-oriented metric paints a clearer picture of a REIT's dividend coverage. The best measure is adjusted funds from operations, or AFFO. AFFO takes a REIT's net income and adjusts for non-cash items like depreciation and gains from property sales. A deduction is also made for maintenance capital expenditures, and upfront rent payments received are smoothed out to give a better look at recurring cash flow. Ultimately, AFFO is similar to free cash flow for a REIT. The main difference is that AFFO does not deduct a REIT's growth investments, since the business model of REITs is based around funding growth spending, like acquisitions, via external capital sources, like issuing debt and equity. Master limited partnerships, or MLPs, also use a unique metric to calculate their payout ratios. Most publicly traded partnerships own energy infrastructure and get paid for moving oil and gas through the networks of pipelines and storage tanks. These assets last a very long time, but like we saw with REITs, they incur substantial non-cash depreciation charges each year that significantly reduce an MLP's reported net income. Distributable cash flow, or DCF, is the metric MLP investors want to use to get a more accurate view of an MLP's payout ratio. This metric primarily adds depreciation back to net income and deducts capital expenditures required to maintain a firm's infrastructure. DCF is similar to free cash flow, but it doesn't deduct an MLP's growth spending, since this business model relies on funding those expenditures with external capital, just like a REIT does. Now that we understand how payout ratios are calculated, what is a good payout ratio? Well, it depends on the type of business. Most dividend-paying stocks have a payout ratio between 30% and 60%. I like to invest mostly in stocks with payout ratios below 60%, since this level provides more cushion for the dividend and makes it easier for dividend growth to continue, even if earnings hit a temporary rough patch. However, certain types of businesses can safely maintain payout ratios above 60%. Telecom companies, regulated utilities, and consumer staples are some examples. These tend to be mature businesses with recession-resistant cash flow and limited reinvestment needs, enabling them to maintain higher payout ratios safely. REITs and MLPs are also exceptions, since they are required by law to distribute nearly all their profits. Seeing payout ratios of 80% to 90% isn't uncommon in these industries, but that's not necessarily cause for concern due to how their business models work. Now, it can be hard to keep all these payout ratio guidelines straight. I like using our website because it makes this easier in a few ways. If I go into the dividend portfolio I loaded into our dividend portfolio tracker here, I can add a payout ratio column that signals whether a holding's payout ratio is low, moderate, or high, depending on the industry it operates in. For example, you can see that AbbVie's 54% payout ratio is a little above average for a biotech company, while Arbor Realty's 76% payout ratio is actually on the low side for mortgage REITs. If we click into AbbVie's page and scroll down to its payout ratio chart, you'll see that we also include a line on the chart showing the payout ratio level we prefer this type of business to remain below. This makes it easier to spot companies with dividends that could get into trouble if their payout ratios run too high for too long. A good example of this was TV media company Paramount, which saw its payout ratio shoot higher as it ramped up spending on its unprofitable streaming service. The dividend was ultimately cut by 79% in May 2023 to better align the dividend with Paramount's investment needs. On the flip side, General Mills' payout ratio chart is what we like to see. The packaged food company has kept its payout ratio near or below 60% over the past decade, and you don't see any spikes, which indicates a predictable business. This makes it a lot easier for a company to deliver consistent dividend growth year after year. If I'm looking for new dividend ideas in our stock screener, I can also use the payout ratio in a filter here to focus on low payout ratios across all types of business. This is nice since entering a hard value like a payout ratio below 60% would eliminate most utility stocks, but our filter adjusts automatically depending on the industry a company is in. That being said, the dividend payout ratio is just one piece of the puzzle when it comes to assessing a company's quality and dividend safety. You also need to understand a company's balance sheet strength, cash flow stability, and long-term investment needs, as all of those things can change a company's capital allocation plans. We spend most of our time each week analyzing all these factors and baking them into dividend safety scores, which predict a company's dividend risk over a full economic cycle. We've been doing this since 2015, and we're the only company that I've seen out there that posts a real-time track record of the more than 800 cuts we've seen during that time. If you flip through the track record, you'll see that high payout ratios and excessive debt levels were a primary driver of most cuts. Our dividend safety scores are available for around 900 stocks and over 100 closed-end funds, which makes it easy to stay on top of the safety of your portfolio's income. There's no obligation, but you're welcome to try Simply Safe Dividends if you're looking for a tool that can help you protect your retirement portfolio. It's free to try and it only takes a minute to get started. Thanks for watching my talk on payout ratios. If you enjoyed it, feel free to like this video and consider subscribing to our channel, which will stay focused on topics about safe dividend investing. Thanks again for tuning in, and I hope to catch you next time.